Good afternoon, everybody, and welcome to the Fintech Nexus weekly news show. My name is Peter Renton, chairman and co-founder of Fintech Nexus. Joined today, sporting his Bills hoodie in support of his team playing tonight. We have Todd Anderson. How are you doing, Todd?
Good, Peter. Go Bills.
Yes, go Bills indeed. And from north of the border, we have joining us again, John White, the editor of Fintech Nexus News. How are you doing, John?
Very good, thank you.
All right. Is it pretty cold up in Edmonton right now?
Well, minus 23 Celsius.
That's cold.
So Bills weather, I guess.
Yeah,
perfect
that
weather
feels like
for a
that
Bills
weather.
game.
Yeah, I think there might be negative in Fahrenheit even. So
It is.
That's
very
cold. That's cold. Anyway, we'll warm everybody up with some interesting discussions here, and another.
We'll go to the Bahamas.
Exactly.
Yeah.
We will be. We actually got to be talking about the Bahamas in the first part of our show today. Sam Bankman-Fried again is leading our news show. He was on the New York Times, or attended the New York Times Deal Book Summit yesterday via video. And Todd, you were there at the show. What tell us a little bit about the Deal Book Summit overall.
Sure. So it was an interesting collection of policy, world leaders, and economic and kind of business leaders overall. You had Reed Hastings of Netflix, Janet Yellen was there. The Ukraine and Israeli leaders were there. Mark Zuckerberg streamed in, partly on the metaverse, partly on just regular video stream. And so you had a kind of a various collection, which I thought was a unique lineup. It went into macro economic conditions, also about competition and what everyone's business is. But one common theme throughout the event was FTX and kind of the not only FTX individually, but kind of the cascading effects since the fall of FTX, and even the preceding events of Terra and Luna, who were mentioned there, and stablecoins were mentioned. And I think people were still pretty shocked and astonished by how quickly FTX had fallen from grace. And in the interview, it was just it was kind of all over the place. I thought Andrew Ross Sorkin did an exceptional job kind of navigating what SBF was trying to tell us. But ultimately, I mean, what he did was fraud in some way or another. I mean, that's what it comes down to.
Let's just say he hasn't been charged with a crime yet.
No.
So it looks like it might be fraud. We don't know for a fact, but there's certainly a lot of missing money.
He either knowingly or unintentionally committed fraud by some of the moves he made. But the one thing I thought was interesting about what he said was he seemed to be putting a lot more on Alameda than he had previously done.
Right.
He had talked a lot about Alameda doing this or Alameda doing that, or I wasn't aware of kind of the direction they were taking. It looks like there was a lot of positions that I was unaware of, making it seem like Alameda was the rogue agent here. And the other thing I thought was interesting, he kept on talking about FTX US was solvent, and he was curious as to why they couldn't return investor money. FTX Japan, solvent, and they should be operational, and why can't they return money today? Someone pointed out on Twitter, FTX US is in the bankruptcy filing.
Right.
So it doesn't seem like he knows fully what's going on.
I don't think he wanted. I don't think he wanted them in the bankruptcy filing. It sounds like, but anyway, it's so. John, thoughts on the craziness that was yesterday's interview?
Well, as I said earlier, I feel like he's too smart to be that stupid.
Right.
And this idea that, I didn't know, and oh gosh, shucks, golly, this is all a shock to me. I don't know if he's delusional, a great actor, or what's driving that, but I just don't buy the fact that he didn't know. And
well, my theory is that I just think he was not a details guy. He's a big picture guy, and the details, he may not have known the details, and he may have relied on others. But just the mere fact, the one thing that I just cannot get over is that in 2022, people who were depositing money into FTX, if you wanted to send a big amount of money, you were wiring it to Alameda. And that is just
why were people doing that?
Because I mean, people wire money, you think, oh, it's a different trading name. Same companies have different trading names. But if anyone who did a little bit of due diligence on that would have seen, oh, Alameda is a very different company to FTX, and it doesn't look like they have same ownership or anything. So
I can buy the he didn't know every position, but I mean, some of the positions and the exposure that they had, and the billions that were on the line, I would have to think he knew about some of those big positions. Yeah, there's probably a lot of smaller positions that maybe added up to some money, but there were some big positions that they had that probably amounted to 2, 3, 4 billion, and that his unaware of those. I find that hard to believe. I do agree with you, Peter. I don't think when things were rolling, he was like looking at the minutia, every parts of the businesses. But I have to think the bigger the position, the more that he was at least aware of the risk they were taking. And ultimately, he's a trader. He's a gambler.
Yeah.
And I think he did some of this and it just backfired on him.
Right. Yeah. Well, he did, the interview, Andrew Ross Sorkin was, he did grill him on a whole bunch of different things, including that Vox conversation. We led the news with this a couple of weeks ago, and he basically admitted, he said, I didn't realize that was an on the record conversation, and I think he regrets that.
Which I don't believe either, because he had previously talking to that same reporter earlier in the summer.
Yeah, I don't know.
And that combined with how I've seen him perform when things were going great suggests to me that this is a pretty good act, because he was much sharper and clearly aware of a lot of the details at some of the other appearances I've seen him at. And now he's like a deer in the headlights.
Yeah. Well, the crazy thing is, and we're going to move on after this, but if Luna hadn't crashed, the Terra Luna debacle, if that hadn't happened and crypto prices had, maintained sort of a decent price, he'd still be going. There'd be who knows, this might have happened in 2 years' time, or it would have happened eventually, I think. But anyway, I want to move on because we want to also just talk about Larry Fink, the CEO of BlackRock, obviously the world's largest asset manager. And he was at the DealBook show yesterday as well. And he said he's still bullish on blockchain technology. He talked about the tokenization of securities that was picked up by several news articles, talking about the benefits. You can do instant settlement. You've got simplified shareholder voting. No middleman, low costs. A lot of things about tokenization that he thinks is still going to transform the financial system. So that was super interesting. Did you catch him, Todd?
Yeah. And, this is where I think the industry and banks need to help regulators understand the differences. Mm-hmm. Because right now, I would presume if you ask a House member or a Senate member, take McHenry and a couple of others, put them to the side. You ask the regular, everyday House or Senate member, what's crypto and what's the underlying technologies, they probably wouldn't be able to separate the two very easily.
Yeah, and they wouldn't even know what tokenization is, I would guess.
Yeah, and so, I think it'd be incumbent upon the industry really to push, like, hey, you want to hammer the risk-taking with crypto, that's one thing. But, the unlocking of lower cost financial products, instantaneous risk settlement, and ultimately a better system, then some of these technologies need to be implemented. And that way you can avoid the stuff like that we were talking about recently with Zelle and waiting 5 days for something to settle. you could settle it immediately and know whether something was fraud or not fraud, and not have this lag in time. And so he was really bullish on it, as am I. Personally, it's the area that I think banks have staked a claim, amongst other asset managers and big FI players. And so that was at least good to see on the crypto side, outside of the the typical hammering of the pricing and kind of where the state of the industry is today.
Mm-hmm. Mm-hmm. John, any thoughts?
Yeah, I agree 100% with that. And I also am still bullish on the underlying technology and the work that continues to be done in the background of developers who recognize this is still the future. And it reminded me that as a journalist, I think part of our focus needs to be on demonstrating the separation of those two concepts. And for all of those people that aren't as savvy, part of our work, I think, needs to be putting a spotlight on the differences and why continuing down this road on the tech side is still really important.
Yeah, and that's the thing. I mean, given how much negativity there is right now, the technology that's going to survive, the technology that's really going to come to the fore in the long term is going to be solid, because it's going to be very heavily scrutinized. So I'll move on now, though. We're still staying with crypto just for one more story. Because we had BlockFi, our good friend Zach Prince, who we've known from his Orchard days back in like 2014.
Yep.
He was the CEO, or he probably still is the CEO, at least temporarily, of BlockFi. They filed for Chapter 11 bankruptcy on Monday. Not a big surprise. They were they were the one that was rescued by SBF back in the summertime, and they said they had more money supposedly coming in from FTX, and that money is no longer obviously coming in, and so they can't survive as an ongoing concern. They interesting, the largest shareholder is Valar Ventures, 19% of the company. That is Peter Thiel's fund, so he is, and they raised a boatload of money. BlockFi over I know they had a $500 million round, I think, from memory, but they've raised a lot of money. But and I'm full disclosure, I am an investor. I have money on their platform that I'm anxiously awaiting to see what happens to it. But I'm not holding my breath on that one.
Yeah, it's another casualty right now of kind of where the market is, and some unfortunate moves by some executives in the positions they made, and making bets on illiquid instruments that ultimately they weren't able to exit quickly to become liquid and take care of customers. And it's I think we're still potentially going to be unraveling some of this stuff even a year from now.
Oh yeah, probably.
Which puts crypto in a really tricky position because there's a lot of good innovation happening, and I feel like we're going to go through this period of kind of uncertainty and just what's the word that I'm looking for? Not if you go to heaven or hell. Where's the in between? Purgatory. Yeah.
Yes.
We're going to be sitting in purgatory for a while, because I think people are also going to be like scared to do things that maybe they were like, all right, we could take a bit of risk here. And in building, you need to take some risk. I think there's going to be fear that kind of takes hold in some places of the market. Maybe I'm wrong, but this is going to be unwinding for a while.
Okay, so I want to move on to Pipe. This has really been interesting to see. This really started before Thanksgiving, November 22nd. The 3 co-founders of Pipe all stepped down. Now, keep in mind, it was like basically revenue-based financing for recurring revenue software, like SaaS companies primarily, grown like a weed. They only launched in 2019, and they a unicorn valuation. And it's just, this whole thing seems bizarre to me, because the CEO officially stepped down. The 3 co-founders are all stepping down, but one of the co-founders is now interim CEO while they're looking for a new one. There were allegations flying around on Twitter. I was following this right just in the days day or two before Thanksgiving. Some of the tweets have been deleted now, but I was reading them in real time, just seeing how the allegations of loans made that were bad, lost lots of money, like just who know? We don't know the truth, and Henry, the CEO, Henry Wurst, I think his name is, the CEO gave a big explainer on Twitter what his perspective was. But to me, what's strange is if when you found a company, do you suddenly step down as CEO and then have your co-founders also step down, and then one of your co-founders is interim CEO? That just
you step down when you find like I think there was a statement or something they said like, oh, we're builders.
Mm-hmm.
And we only build from like 0 to 100, and then we find the right person to take it. Yeah, whatever the saying they made. No, you don't do any of what they did unless there's a full team that you're all right. Time for us to step down, and here's the new team.
Right.
Yeah.
But no, they step down, and one step back in, and one's arguing with people on Twitter, and one's clearly something happened that in some way they probably did wrong, or at least part of what they did were wrong. And they left some exposure either to themselves or to the company. And they thought, hey, if we step down, maybe we at the very least, we leave the company on a separate trajectory from what's going on with us. Because they'll probably keep some ownership stake, and they'll probably hopefully cash that out sometime down in the future. But yeah, I mean, this is not normal behavior at all. And I think one of them also said, hey, we were looking for a COO, and then realized we really need a CEO.
Right.
Come on. I mean, some of it's just, hey, give us the explanation. Like, something got screwed up. You guys needed to get out of there. You want to leave the company on the path, but it's been very confusing.
I think, my feeling is they were pushed probably by one of their large investors. But
oh yeah, I mean, investors usually hold that power.
Yeah.
I kind of felt like they had a sense that it was about to hit the fan, and they were trying to get ahead of it. And then the fan didn't come for whatever reason, or it only came a little bit. It was turned on low,
right?
And so it wasn't they weren't canceled essentially as a company. So there's a scramble now to kind of try to have the optics show that, hey, all new leadership, off we go.
Yeah, I know
the toothpaste was out of the horse at that point.
Right.
It still somehow relates to crypto, which is it's just amazing how many things relate to crypto right now.
Right. Well, there's more that will be revealed at some point, I'm sure, with this story. But I want to move on to some more news. This was really interesting. This came out this week. There's a new digital, what do you call? I guess it's a digital dollar type offering now, and it's from banks. So you've got Citi, Wells, TD, US Bank, and others, I believe, that are all getting together, and they're creating this thing called the Regulated Liability Network, and they've got a 49-page white paper, which I have scanned. I haven't read the whole thing, but it's super interesting. And they're basically, what they're trying to do is they say you've got CBDCs on one hand, which obviously government central bank backed. Then you've got stablecoins on the other hand, which are unregulated and issued by non-banks, at least at this stage, and there's nothing in between. Now, obviously, we've had figures. USDF consortium is in between. This is a different type of offering, and the USDF consortium has a number of banks. This is another consortium. Looks like it's going to be a competing one, operating on a shared ledger. So it's like a private blockchain just within these banks, and they're going to be able to have multiple forms of digital currency that they can operate. I thought it was super interesting.
Calling off founders. If you could figure out how to, in payments and in crypto, how to connect all these disparate networks, I think you'll have the technology that helps unlock, the potential here. Because, this is all good, and I think banks should be toying with this, but it also leaves open the the question of, I think Chase has the IIN, which is the interbank information network. That's blockchain and payments based that they do, large scale transfers on. Then you have this consortium. You have the consortium that you mentioned.
There's Tacit Pay as well. I got Tacit Pay on my podcast coming up next week.
I mean, what happens with all these, networks that are not operating or are operating within themselves and not coexisting together? I think it's going to be really interesting to see how the layer in between these and what happens, who builds that connected layer. Because I think that could be the biggest piece of the puzzle that we have not yet, seen out there. Because that's a worry that some of this is capped if you can't connect into the other networks.
Mm-hmm. Mm-hmm.
It's very much a controlled toe dip to test the waters.
Yep. Yeah, and we had Stephanie Kirkpatrick from Orem on the news show just, I think it was like 3 weeks ago, and that's what her company does, is takes all these disparate payments networks and brings them all together. And this is going to be an opportunity, because you don't want to have these walled gardens that can't talk to each other. It's not going to be very efficient. And clearly, there's at least three. Then you got the real-time payments network. You got FedNow. It's real-time payments are going to be a thing, very soon, and there's going to be like 5 different systems that happen. But anyway, I want to move on, because this next story really irked me, and I want to get on my high horse here. There's the lead story. The lead story in the Washington Post. I went to their website just a couple of hours ago. The lead story is the more you submit, the more we get paid. How fintech fueled COVID aid fraud, and basically slamming fintech, for saying that it was just, this is all about the PPP program, right? So PPP program, incredibly important. I think personally one of the most successful programs in the history of this country, because it did what it was said to do, and it was $800 billion. You're going to have some fraud when you've got $800 billion sloshing around. And there was, some of these fintechs probably did, reading the article, there were certainly some fintechs that had nefarious practices and really were trying to scam the system. Most fintechs were not. Most fintechs were really trying to help. And if you remember that time in April of 2020, I remember it. It's burned into my brain.
Yep,
burned into my memory that time, because it was so intense, and we were just looking for to try and get a PPP loan ourselves, and our bank wouldn't talk to us. So of course we obviously know fintechs well, so we went to fintechs, and so they really did a lot to get money out to people who needed it. And now, after the fact, they're being bashed by these articles like in the Washington Post, and there's many others that are floating around there today. And this was just to be clear, this was a 120-page report released today by the House Select Committee on the Coronavirus Crisis. So that's what the news is, and not good news for fintech.
No, and I think part of this falls right in Congress's lap, who are now, after the fact, trying to come up with, there was a lot of fraud. Like, to be honest, it didn't matter how much fraud there was going to be, because the whole intent of the program was to stabilize businesses, so a ton of people were not put out on the unemployment line.
Mm-hmm.
And it did just that. And yeah, there's going to be fraud, but honestly, the fraud pales in comparison to how beneficial the program was. Peter, you wrote an article about our process and our acquisition of PPP funding. It saved our business.
Yeah.
And how many companies can you say it literally saved their business? And because Congress has to account for dollars, they should have accounted for, hey, there's going to be fraud. Yes, we should examine where the fraud is, and the egregious players, let's go after them. But there's plenty of more that were not egregious, that were under basically pressure to get the money out under a clock.
It was all about speed back then.
It was all about speed.
People were so pissed that Bank of America, Wells Fargo were dragging their feet. Meanwhile, they have payroll to make, and are they going to fire these people, lay them off because they can't get a PPP loan? Speed was so critical.
And the other part the Congress screwed up on is they should have forced the banks to lend some of this out. the banks did not lend to people who were not their customers. At least the
Right.
majority of
Yeah,
them.
at
I'm
least
sure
initially.
some did.
Yeah.
And so all the risky bets were put in fintech's lap. So right away they were starting from behind when it came
You're
to
setting
fraud.
them up for failure immediately.
Yeah.
Yeah.
And the banks, oh yeah, we followed the rules and everything. Yeah, because you knew the people you were lending to already. So I think it's comical. I think it's unfortunate, especially with everything else going on in the market, that now fintech has this mark against it as well. I think it's a tricky time right now for fintech with what's going on in crypto and stuff like this coming out. Founders need to be out there and talking about it.
Yep. And I want and so we're going to spin around and stay with SBA programs, Small Business Administration, because this was sort of the other side of the coin. There's an article in Banking Dive this week. Can the SBA make its 7A loan program attractive to fintechs? And the 7A loan program, obviously that's the SBA's big program, $36.5 billion last year. Whereas the SBA guarantees a high percentage of the loan they will pay if it defaults. So so it makes it a very attractive product for banks, because small businesses are very risky to lend to, and banks wouldn't lend very much if they didn't have a guarantee. So that's the program. The number of non-bank SBA lenders has been capped at 14 since 1982. Now, most of these non-bank lenders are not fintechs. They're just non-bank lenders that have been around forever.
Yeah.
But companies like Funding Circle, who is a fintech and wants to get an SBA license to do 7A loans, has not been able to, and there obviously is movement at the government to do this, but I'm hopeful that some of the previous story doesn't sort of negatively impact the chances of fintechs partaking in here. I worry it will.
Yeah, it probably will. Without that report, maybe you have more Funding Circle likes. But now there's probably only going to be a couple that end up getting approved, if at all. And they probably have to go through an exhaustive, rigorous process, 10 times worse than it probably would have been otherwise. But I mean, this program should be done by fintechs and small banks. I mean, those are the only two that are truly serving small business. The more options that you take off the table for small business, the less people are going to want to start their own shops. And it only feeds into big corporates, acquiring more real estate and more market share. And small business has a huge role to play, and we shouldn't be enabling that more.
Okay, we're going to finish today we're going to go back to FTX. Our good friend Penny Crossman over at American Banker wrote an article, Surviving FTX, Fintechs and Banks Untangle Themselves. And it was really good piece with Jason Wilk, who is we've had him speak at our events. I've had him on my podcast twice, actually. He's the CEO of publicly traded Dave, the banking app, or it's an app to help people who need just to help sort of the less more underserved people, underbanked people, to help them kind of cope with paycheck to paycheck challenges. Anyway, Dave was going to go into partnership with FTX, looking at doing like crypto rewards or something, but never actually consummated anything. So that they got lucky there. They didn't do it, but there's several others. Silvergate Bank has less than 10% of its $11.9 billion in deposits linked to FTX. So that sounds like that's like 10 figures. Farmington State Bank received an $11.5 billion loan, not a loan, an investment from Alameda. So it's like, as we say, we have fintechs, we have banks that are all starting to untangle themselves, and it's quite the process.
Yep, we're going to be listening and reading stories for a long time.
Mm-hmm.
It's going to take a year to untangle the tentacles, I think.
Yep, for sure. But anyway, that is all we have time for today. Thank you, John. Thank you, Todd. And thank you to the listeners or viewers. Appreciate you stopping by. Now, before we go, we want to give a short plug to Fintech Nexus LATAM, Latin America event happening in Miami, December 13th and 14th. Still tickets available. Go to fintechnexus.com for that. And on that note, I will wish you all a good afternoon and a good weekend. Go Bills. And
Go Bills.
we'll be back here same time next week. See you, everybody.
See ya.
See ya.